So as we move forward, we understand that we get some requirements coming out of that agreement. Now, the key thing, again, is reading to those agreements, understanding what your clients have to do. At the end, interpreting or looking is more important than maybe you can imagine. So surplus cash, by the way, big problem, right? Three different calculations, 2 distribution methodologies. We have quite a ways to go. Last year, HUD did issue that little notice about how to handle those items, which we've already covered. Okay, now, as a foundation item again, let's go back to Chapter 1 of the Audit Guide. Obviously, you have a financial statement audit. You have a compliance audit. Thanks for coming to class. That's something you already knew. You knew it had to be in accordance with the Yellow Book. But the last 3 things are what's really important for everyone to realize. And I know I say this about every time, but it just bears repeating. There are so many people who are leery of making changes. Look, your judgment is what matters here. Frankly, a lot of people see themselves at the bottom of a pit. HUD's here, client's here, you're at the bottom of the pit, and you know what rolls downhill, right? It just feels like that. The truth of the matter, frankly, is very different. Client is here, HUD is here, you're here. Why? Because you're the one with the information. So HUD, quite frankly, they have processes and agreements and things they follow, systems. All that's designed around the averages. You're not dealing with the averages. You're dealing with your client-specific agreements and your interpretation of those agreements. Client, bless their hearts, many times just need you to run interference for them, frankly. They need protection sometimes from a HUD, and you are that protection. And sometimes you're also the other side where you're HUD's protection. Welcome to the profession, the only profession I know of that serves 2 masters. The users of the statements and the client who produces the statements. I don't know what else to say about that. We're the only profession that does that. And so you are responsible for exercising the judgment about what is or isn't non-compliance. Now that matters importantly to me right after lunch, because we will go into a discussion about how we determine or assess findings. So I really wanted this to be clear because as we get into the discussion about how to decide something is a finding, there are very, very few things that are so cut and dry you don't exercise your judgment in every case. And I find that the greater the experience of the individuals involved, the more judgment that they apply. The less experienced people, the more they adhere to certain rules listed. For instance, security deposits. The security deposit cash is $400 less than the liability at December 31. It was fixed on January 4th. Is that a finding? Well, yeah, technically it's a finding, right? In fact, the regulatory agreement said one of the 3 things we measure is the deposit equal to or exceeding the liability. And yet most partners I talk to said, I'm never going to report that as a finding. And staff will go, it's a finding, right? Well, what is it, right? You guys are laughing.
We're laughing because it depends on the partner.
Well, that might be true too, okay? So what matters to me here is in how we apply our judgment to that. I don't necessarily know there's a right or wrong answer in every case either. HUD says it's an absolute certainty that should be a finding. And I go, now let's think about this. I'm going to open up a complete review process, and whatever Pandora's box that means, for a $400 item? Maybe I don't want to do that. Okay, so how do I work around that? How do I justify that? How do I apply my judgment to this? Now, HUD's clear And this is the other thing, and you guys know me well enough to know how I feel about all this. I want to exercise, in fact, I want to exercise my judgment. And I want every conversation about my work to come back to my judgment. Guess what? That's where all the conversations should always be. It shouldn't be my lack of documentation. You don't know what I did. You don't know. It's just simply down to what? I don't agree with you. Because now what we're talking about is, Jana, I don't like your judgment, so I really don't like you, right? Well, now we've moved it into a personal argument, which is sort of a baseless thing. I know what she did. She told me what she did. I just don't like it. That's a big difference from saying, well, Jana, I don't even know how you did this, right? So you didn't document how you did this. So how we apply our judgment is a big, big deal in all of this. It's never been meant to be taken away from you. You are the interpreter of the agreement. Now, HUD may second guess you, right? But you may second guess HUD. There are plenty of times here we need to tell HUD what I call the Jedi mind trick, right? These are not the droids you're looking for. This is not the non-compliance you're looking for. It's really not non-compliance, right? So we do that all the time. And what are the requirements, though? Look, you retain your judgment. All the compliance areas or types of compliance areas must be addressed. And you should perform procedures to ensure the guide is current. Or I would even add now, complete. It's not current today. I'll prove that very easily with Section 8 testing. There are 4 things that are absolutely just wrong in the guide. As the guide sits today, if you were to follow the guide, you would be wrong. Okay, you would make mistakes in compliance. So it's up to us to do that. And that's why I'm always surprised by people who keep arguing to me, well, that's not what Chapter 3 says. And I'm going, I don't care. The question is, am I right? Okay? It's not the question of whether Chapter 3 is correct or incorrect, or I should follow or not follow. The question is it right? Am I testing the right material, or is the procedure correct? Or is there something better that may happen? Now, I had talked to peer reviewers lately, and you wouldn't be surprised, because I know you see some competition in this area. There are literally people who are doing HUD audit guide audits for single audit clients because they don't understand the difference anymore. They claim HUD confused them with this by saying if you're an insured mortgage, and by the way now, if you get one of those new regulatory agreements, 100% of those regulatory agreements in the new world will not have compliance supplements for them currently, unless they write one next year. So that means you have to come back and use the audit guide has your testing vehicle, but it doesn't mean you're taking them out of A133. I don't know why I have to say that. I'm not really saying that to you guys. I'm maybe expressing my frustration with the CPA crowd around the country who keeps misinterpreting rules. All we're really saying is this, you get some procedures from here, but everything is still A133. Anyway.
Using a judgment standpoint like this, it's really
Mm-hmm.
and to us, it's maybe not material.
Mm-hmm.
Is there a way, as far as the reaction machine goes, because that's going to pop out immediately just because the line item for the liability exceeds the asset, or it doesn't seem like the auditor just missed it, or just wait to deal with it when they raise the question? I'd like to see that.
Let's put it this way. If I'm involved, it never goes with the numbers wrong. Did that answer your question?
$400 transfer from your operating account. So
Absolutely. Do you care?
sometimes it depends on the client.
It depends on the history, too.
Right.
How often they do this.
If it's a really small project and they only have, 3,000 of security deposits, then yeah, $400 is a good deal. And if it's a 200, 300 project, then, and it's 60,000 or 100,000, I don't care.
And for me, I'm more concerned about process.
Right.
Okay? Why is it wrong? Well, somebody went on vacation in December, blah, 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 missed it, okay, came back and booked it in January for 3 days. I don't care if it's a small project. Even though that's 20% miscalculated, I'm not going to still report a $400 item. Now, here's the other side of this. What most people don't understand, and I have something specifically on this in the findings. The first line of defense on that, by the way, so how do you exercise your judgment? The judgment I make internally is I don't want to report this as a finding, okay? Now, I know that in my head, so how do I get around it? Because I may not have a finding, but if I send it in without a finding, it's going to be a HUD issue anyway for $400. So I'm preferring to not send it in with the $400 difference. Okay. So how do I do that? Well, first off, what people don't understand is when I look at pet deposits and other things like that, they don't have to be maintained in the same way that regular security deposits do. So my first goal is to estimate how many pet deposits and other things are in the liability that aren't technically required to be set aside the same way security deposits are. So I reduce the liability. If that doesn't make me happy, I don't mind the cash transfer. It's just a transfer of $200 because they've just made it later. Now, if they do it consistently, you're going to get a finding. Because why? Hell, because you're dumb. I've tried to work with you all over, and now I'm going to smack you upside the head and say, look, we've tried to work with you on this. My judgment, I can extend it in some places, but sooner or later, my Gumby elasticity goes away, right? There's a point at which, wherever that is for you, sorry, I don't need this slide right here, depends completely on your judgment. So we'll talk about the findings right after lunch. We'll have a complete discussion about that, on how to apply that. Okay, so look, what we see first of all in our conversation about findings are the items we know go directly to DEC. Now, most of you know about this document. HUD told everybody early on in this process through this Miller memo, especially the field office, that they were going to do some things automatically. And this is why, I look at this memo. Automatically referred to, multifamily, or REAC, refers without a REAC analyst review projects with one or more of the following compliance deficiencies identified by the system. Failure to make a residual receipts deposit. Now that means also failure to make it within 90 days. So what if the client reported it within, or funded it with, or funded it, yeah, okay, made the deposit at day 94. Can I have a finding? Now if you understand this process a little bit, that finding will be automatically referred to either multifamily or to DEC without even an analyst review. So you're going to open Pandora's box, right, for a complete financial statement review for one issue of being 4 days late on the deposit. Now, if you know those things, are you more likely to have your judgment swayed in favor of one way or the other? Because the risk, here's what you're going to decide, right? I know how this works. You're going to decide the risk of the review is greater than the benefit of reporting a 4-day late deposit that HUD can't verify on its own anyway. So in the work papers, you're going to say, look, I don't think this is direct and material, and so they were only 4 days late. And you may justify that with some other language. Failure to invest your reserve for replacement or your residual receipts. Look, for lack of $1 of interest in that dang account, it gets automatically referred, frankly. Now, I know most of these don't generate a lot of interest anymore. In fact, sometimes they don't generate to offset fees. So people would say, I don't report that there. And I'm going, no, you probably need to do that. Underfunded tenant security deposits, a $400 item, puts me automatically in a review without a REAC analyst. So I just wanted, even segregation of duties, right? This segregation of duties issue, especially in cases where I'm not intending them to fix it. I'm just reporting it's a small entity. I have a segregation of duties issue. How do we fix this? I don't fix it. We're just reporting, right? Well, that opens up a whole other can of worms for that. Plus, if I have a Section 8 finding, failure to properly administer, that's a code. All my Section 8 findings would generate automatic referrals to multifamily housing or to DEC, depending on the limits of the dollar value of the noncompliance. 10,000 would go to DEC. Anything under 10,000 goes to multifamily housing, and we start a complete review of the financial statements because they're telling us REACT's judgment isn't even involved in that decision. Unlike equity skimming, right? Equity skimming stuff goes to REACT's judgment because they're afraid of detecting stuff in the system that does not actually represent equity skimming. So before they jump there, they want to read the facts or the disclosures that you've given them. So this is sort of a knee-jerk reaction, and that's why we get down to having this discussion more about judgment and understanding, like even say the deferral or the referral flags to the division of or to the departmental enforcement center. So that's what that stands for, Departmental Enforcement Center. And they are here to make sure the regulatory agreements are enforced, which is, again, the biggest single problem RD has. We really have 30% of the entities not even auditing anymore, and RD does nothing to them because they don't have any monitoring or enforcement capability, so it just languishes. And that's the biggest change, by the way. When you write these new rules, it's not about getting audit requirements in. They already have the audit requirement. They can dictate that at a moment's notice as to change the audit. The issue is really how you enforce these agreements in their world. And their OIG group has been very specific. I may share some of that tomorrow about what their problems are in enforcement, because it's not about the audit. They think it is, but it's not. And Stephanie knows that. She knows she's got owners running everywhere, and it's tough to manage them like cats. HUD's got it wired down so tight, hell, they're going to make, they make penny pinchers look like crazy people sometimes because of their oversight. They're so direct. So, look, we have 8 surefire ways to go to DEC no matter what. Don't pay your mortgage. Don't fund your reserves. Change the ownership. Now, of course, these two, we add information in the statements that calculates that. This we have to tell them. Generally, this is reported on our financial statements, but the rest of this is what they're trying to detect, and we already know that. So this is where they're going with all of it at that level. And of course, my famous Peter Bell's famous slide. Because we only live right here. This is where we live. The rest of this whole thing I could care less about. It's all just about this. Where we come out here with these financial statements and what they will look like to that little dude. And of course, some of these don't even go here anymore. They go straight here, depending on their issues. So the only thing we show this for is to make sure everybody's aware of how important their judgment looks in the system, what decisions you make, and what the opportunity to be second guessed is, okay, and how you want to make these decisions with all of the facts and circumstances in your decision process. So we're trying, very carefully to keep up to speed with those. Like I said, try to scream at the analyst, all in caps, whatever this is. Sometimes it's to highlight the findings. Sometimes it's to highlight this is not a finding. And, of course, trying to make sure we are expressing the outcome of the judgment we've asserted as clearly as possible. Now, footnotes are extremely important now in the surplus cash area, which I described. You really just need to be up front with them. And if you have a Section 8 contract that's not held responsible, it needs to say that. Literally, I've been in 3 private classes lately where I told people, look, if your HAP contract is silent, has to distributions, you can distribute whatever darn money you want out of that thing. Surplus cash is irrelevant, and they were shocked. They're saying, really? I don't have to manage it, but it doesn't mean anything to you, so ignore it. File it and ignore it, and tell HUD that we don't have to live within those rules, and HUD will look. REACT knows that. The rest of the field offices and all those people, they don't necessarily get it because they just assume, based on a system-driven calculation, that you're going to have to live within that rule because the REACT asks for it. But the agreements dictate the behavior. DEC knows that. REACT basically knows that, but the system needs to be reminded in your disclosures that it doesn't matter. So even in those cases, we need a footnote that says the contract, the HAP contract does not restrict our distributions, therefore distributions are technically in excess of surplus cash. Now maybe that's not smart, but it's not a violation of compliance. Okay? You have to fill out the form. It's just you're not tied to any kind of outcome from it. Now, the statistics I've been shown before. That's fine. And I'm not really interested in spending too much time on this. You're fighting upstream. Remember, I showed these. I had 5 or 6 slides like this last year. I only left this one slide in. And I don't know how many classes I do. There will be an hour of conversation that's like this that will never change because it's just always the most fundamental thing we deal with. Look, when you come in here, what you're fighting against is their system behavior. I'm an analyst. I open this up in the morning. What do I know? Mountain Green Housing, it says REAC EC star 621, 2012. This means the REAC system thinks this needs to be referred to Enforcement Center as of this date. Now, the analyst's job is to do what? It's to decide if these are correct findings or not. But their goal is to move it off their desk. They don't enforce anything. They just say, hey, the system made a good assessment. So he's really likely, he or she may love the temptation just to do this. Push the save button, right? Off that referral goes. It's off my desk. I'm done. The assessment was done by REACT. REACT's now complete. It goes to the field office, in this case, or enforcement, which was what that system referred to them. So, of course, the first thing they do is open up the findings, and if they see you and them agree, they're done. That's all they do. Well, it's when you don't agree that they get concerned, and of course, they assume system's right and you're wrong. That's just how this works. So you're guilty until proven innocent, and this process requires you to prove your innocence in each of those cases and at least describe what you're doing with that client in the footnotes. And if you need to make them read them, then you need to make them read them. Sometimes I scream at them. So anyway, that's not news. It's maybe news to some of you. They don't start this review with the financial statements and go in a logical process. They come to the screen, they click on the findings. They look for agreement. If they have agreement between the CPA, if the codes align, they push the button and they're done. Because they assume you and the system agree. Well, that's pretty much a double check, so off they go. And, of course, most of them do not agree, which causes them to go into the review mode. And, of course, the compliance flags, slides 16 and 17, are the most popular ones, which there really are 16, are no real surprises. Now, the problem with jumping over to the field office, say you go to DEC and you go, hey, Les, I'm okay with going to the field office. Even if it's automatic, right? So I say, well, not so fast about what we're doing here, because they, by their own admission, say they're going to do a more comprehensive review. What's the last thing I want? REACT looking at it's one thing, right? Because they see a lot of these. The field office, on the other hand, is a mixed bag of approaches. So I may have good ones, I may have bad ones, I don't know how I'm going to get reviewed. In this restructure, you don't know where your clients are going next, do you? Have you had some actually moved? Do you know? Okay, so you may, once these guys move, I now have a bunch of people unfamiliar with the process reviewing my work. They don't know my client, and they may not be as invested in my client. They've never visited the location. They don't know the project. Now we're going to open this whole other review open, and their goal is, again, to check for all this process. I had these slides last year. We're not going to talk about it very much today. I wanted to kind of look through this emphasis here. Security deposits. Well, I don't know why they worry about that, because REACT tells them we're either funded or not funded. Payables, receivables, and liabilities. REACT should have already highlighted most of that. Vacancies and bad debt, though, is a very interesting one for me that I'm going to come back to in a minute. Of course, miscellaneous expenses is where they spend a tremendous amount of time down here. I want to stop on slide 22 for just a second. Slide 22 puts me in this position to ask what HUD looks at. Now, the field office told me this. So they're going, look, here's our concerns. Now, I just stop here for one reason. I have a cash receipts test that, for all intents and purposes, is a waste of my time in the audit guide today. Now, maybe you don't agree with me on that, but it doesn't help me achieve my objectives of determining that all the rents that are supposed to be here made it here. It basically asked me to test certain things I know are already recorded and to see that they were deposited timely in the bank. Well, that may give me some sort of small warm and fuzzy feeling, but it doesn't achieve really any audit objective except it complies with the guide. And then HUD tells me, the OIG tells me in the guide, well, only look at vacancies at 15% and bad debt at 10%. Well, bad debt at 10 is a catastrophe, right? 10% of revenue being written off, that's like apocalyptic at some project. So the audit guide's a little wacky. So I asked myself, what is the field office doing here, and how are they managing this? And furthermore, what's the client doing to manage this? Because in the end, you'll see in just a few minutes, this is the crux of my cash receipt problem anyway. Now, we're going to be told something very specific by our own audit standards about this in just a minute. So I wanted to stop here and just have that conversation. Now, of course, they freak about these miscellaneous expenses, the idea, I guess, of which is including anything miscellaneous in the submission means it's at risk, because I would never hide my riskier items in big numbers. I would always show you my riskiest stuff in the detail of the miscellaneous. So they go crazy on those miscellaneous accounts in their review, because they're considering that that's where the weirdness would be. You and I both know, and even RD knows, the weirdness would be in the maintenance accounts and probably contracts, which are, in their case, they're worried about IOIs, and I think that's a legitimate concern. But, okay, so the rest of this is fine. I don't really get too excited about it. So let's go to slide 26. Now, all this other environmental information has been gathered. We understand our agreement. Now let's come back to standards and say, what's the minimum things I have to do? I'm not interested in auditing anything that I don't have to audit at all, right? I'll be honest. How much audit work should I do? The minimum amount required to give my opinion. And so what is required of us at a minimum? Well, HUD starts off with this idea of the financial statement audit, which is fine. Do enough audit work to give your opinion. Okay? I'm good with that. That's not really my concern here. The second bullet is more of an interest to me. Follow gas and obtain an understanding of an internal control, blah, 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 blah. All that language is wrong. That whole sentence is wrong. That's not how we look at things now in the clarified standards. But it does say, at a minimum, follow AUC section 315. Oh, now wait a minute. I think last year my comment on this was good. I don't have to test internal control or financial stuff, right? But I didn't actually ask myself, what does 315 actually require? What does 315 require us to do? And does it benefit us at all, or does it cause us some grief? Well, if you can go to section 3 for a minute, we're going to step out of this and go to section 3. Okay, clarity stand. Go to slide 17. Clarity standards are probably anything but clear to most CPAs. I was listening to Marlo, one of our AI CPA guys. He is the AI CPA kind of type speaker we bring in, Marlo Hunter. And he was going through this all blah, 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 blah stuff, right? That's how I kind of listened to it. Blah, 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 blah. Well, he got to this slide, and I was in the back dealing with something about lunch or whatever, whatever administrative problems are going on. And I heard him say this. He said, look, the AUC 200, the basis of the clarity standards, explicitly requires that auditors follow all AUC sections. And that they must understand the entire, and these, by the way, these are the AICPA slides. Kathy reformatted them into our template to keep them consistent, but I didn't write these. So they said the auditors must understand the entire text of the relevant AUC sections, and it prohibits an auditor from representing that he or she has complied with GAS unless they followed them all. Now, our problem is not that we're giving an opinion on GAS, although that is a problem. Our opinion is that we're giving an opinion in accordance with GAGAS, and the clarity standards have already been wrapped in by reference into the Yellow Book. Okay, so that's great. I need specific procedures to evaluate the sufficiency of evidence obtained by reference to the objectives in each AUC. I don't even know what that is, frankly. I can only disregard a section if the section is irrelevant and it doesn't exist. Presumptively mandatory have to be applied unless it's ineffective. And if I can't achieve a section, well, that's all great. Okay? Now, I stop here just for that particular reason because I'm concerned that we really, and I'm not here to talk about clarity standards all day. Okay? But the audit guide specifically mentions 315. Okay, 315. Let's go down to slide 38. I think it's 38. So if the audit guide mentions one particular thing in it for internal control, and it's new to me, and it's calling for it, and I'm stuck with these requirements the way I am, maybe I need to do something to look at what this is. So, 315 has some new requirements in it. Now, this is the new stuff, along with all the other things that happen in here. And by the way, to help me deal with this, I put together a checklist on clarity. Now, you might not care about this per se, because a lot of people count on, say, PPC to carry them across the line, right? You're counting on that to be compliant with most of your requirements. On the other hand, I'm now in the process of writing my own Excel-based audit stuff, I guess that would ultimately compete with PPC because I'm tired of it. Every time I sit down with people to help them understand PPC and they want to ask me, Les, what's the difference between the planning form for a sample of a substantive sample for the financial statements and then a separate planning form for planning a sample for contested controls and a separate planning form for coming up with a sample of compliance? I don't know how to explain all that. I don't know how to explain 3 separate forms, right? For me, a test of compliance should be a test of the cash receipts or something like this, right? It's a compliance test. It's a financial statement test. Hell, I hope it's a control test along the way. So anyway, I'm doing this for my own sort of benefit, I guess, at another level, but I'm tired of this. And so I actually just made this little spreadsheet. It's not really a spreadsheet, a Word document, to gather up all the clarity standards and give me a checklist for these. And I had college kids just come in and take each section and come through it and highlight it. So I will know how I'm complying with clarity. And I don't expect people to really go through all this per se, but for me, this is how I make my evaluation. Now, if I were just to start here at 315 on the paragraphs, this 315 is probably one of the longest ones. Well, that's not 300. Where did I cross 300? Somebody yell at me when I... Okay, here we go. Risk assessment procedures should do the following. Inquiries of management should consider whether information obtained is great. Engagement partner has performed other engagements for the entity, blah, 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 blah. Now, I could go through here. Internal control, obtaining understanding of controls relevant to the audit, understanding of the control environment as part of obtaining that it should evaluate. That's all fine. Most of this isn't a big deal. But 17 gets me to a new one. If the entity has an established risk assessment process, referred to hereafter as entity risk assessment, this is a new paragraph. If they don't have an established process or they have an ad hoc process, we should discuss with management. Now, here's the thing. If I go back to the slides. Oh, I hated that. Why you don't come back to me, little Sheba? So, here's what we get out of this that they tell us is new. The new portion. I kept this down onto the new portion. Specifically consider whether the entity's control environment promotes a culture of honesty. Okay, that's great. I'm a little more concerned about it being a culture of compliance at this stage, because this whole audit is going to turn from a financial audit into a compliance audit, and it's going to blur the lines all along there. And in fact, compliance about honesty or equity skimming is really the gist of this audit anyway. So, I have to specifically consider whether the entity's lack of a risk assessment process is a material weakness. Internal audit, that's fine. Now, slide 39. This is the key. We are to ask or determine or gain an understanding whether the entity has a process for identifying business risks, estimating the significance, and assessing their likelihood. If I were to ask you today what your client's business risks are, what would you tell me? What do you think those business risks are? Right? It's a simple business. Rent the units, collect the rent, maintain the units, stay occupied. What else? Environmental concerns they don't know about. Unknown. Okay? Lead paint, all these other problems, right? Yeah, well, they have lead there, I can tell you. And asbestos, and whatever else. That's why they haven't torn them down. It's too expensive. What else? I think they're concerned about the physical state of the building, aren't they? That's a business risk. So, if I think I had yesterday, people who actually, both of them, both the clients spoke up, and they said, look, here's how we define it. I'm scared a lot of people. Right? The unknown about regulatory fire. I'm going, okay, we're here to help you with that. Right? We're kind of here to help you. Leave you with if you have subs, then you have HUD risk there. So renting the units, getting people in, filling units is a risk. Collecting cash, collecting rents certainly may be an issue. They want to make sure they collect their cash. Do you think that any client will tell you the risk is that they're keeping cash in a locked safe overnight and not compliance with the guide? So anyway, that's why we want to stop and have this conversation a little bit, because slide 40 continues this discussion. If the client has an established process, we get an understanding, we evaluate the risks, we see if it failed. If the client client doesn't have an established process. We discuss whether risks have been identified and whether that lack of risk assessment process is a material weakness or a significant deficiency. Now that's a pretty specific list of things that we should be doing. That I don't know how PPC's adjusted to that. I can tell you this. PPC was delayed significantly the release of their data. Marlowe tells me the reason for that delay was to rewrite the internal control modules to be more compliant with 315 and the new code set. So we expect some changes coming out of that this year. But the point for us, for me in particular, is let those changes, or let this procedure dictate or drive what tests you perform on compliance or internal control to help you fulfill those requirements, and not so much adhering to a cash receipts test. Most of the other things aren't so bad, right? But cash receipts is really broken in the guide. So we'll address that in another few minutes. We'll after lunch. So we come into this, and we're told, do 315. And so I'm happy to go do that because it's going to open some doors for me to get me out of a conversation, I guess, a little bit, to help bolster my documentation or judgment as to why I'm doing something different in the guide. So that's good. I just left it the way it was. Why is it not recording? I'm not on meeting.
I just didn't see it, so I just wanted to make sure.
Oh, it fell? Did it just fall down? Want to pull this out?
I just understood it wasn't.
Did it fall off? Well, it's a little different because it doesn't have a lot of grippy space.
We just have a lot of people who need to hear your voice that aren't here today.
Well, maybe it was an ambient microphone picking it up from the floor as my feet drug it on the ground. I better be recording. Okay, so now moving on with the guide. A compliance audit, test internal controls, test internal controls, test internal controls over compliance. Okay? Now, last year, by the way, this whole $500,000 item, you got an extra 30 days last year because HUD didn't think you could determine $500,000 in expenditures. Who knows? There's always somebody, Daryl seems pretty interested in making sure you stay happy. The old director of REAC told me that he would prefer just to give it 120 days and be done with it, but the program office wouldn't let him.
We all send emails and they're like,
No. But if you can find a reason in those emails, Daryl did that on his own last year. So Scott Loveday, when he announced it, I kind of complained, don't do this. Don't do this. Trust me. I know my population. You give them an extra 30 days, they'll ignore it until the last 10 days again. It's just the way it works. And they'll go work on taxes. They'll go work on something else. They'll push their deadline out in front of them. And I said, why did you do it? And he goes, well, Daryl just did it. So I don't expect that to be the case. But internal control over compliance is our concern. Now, audit guide, a couple of issues on the audit guide. If you go to section 1B, there are 3 things I have to tell you about reports. There are no changes in the reports. But I have to talk about 3 things. So go down to 2-14, the last page of the first report. Section 1B is right after the Section 1A. This paragraph continues to give people grief. And I don't know what you guys did with it, okay? the highlighted one. So this is the concern for a lot of people, to include or not include. Initially, PPC took this out last year. So it all comes back to this, your judgment of what is other information under AUC 920. So I don't care if you include or don't include, frankly. For me, I prefer inclusion. But I'm not here to make everybody's decisions about this particular thing. So the point we have with it is just this. Other information, primarily in my mind, came down to the schedule of prior audit findings and the inclusion of all that extra stuff that HUD now requires in that schedule. To me, that made this schedule other information. In the past, it only was your prior audit. We were only including your prior audit findings. So, look, that was fine. They were your prior audit findings. But now we're including your prior audit findings and the client's representation of this other data. So HUD reports, HUD management comments, things that were pointed out to be inappropriate kind of findings, if you will, in that sense. So I prefer that interpretation. So mine would say this: the accompanying schedule of prior audit findings and the corrective action plan have not been subjected to auditing procedures. Other people didn't believe the corrective action plan should have been part of the report package. I think HUD says it is, but single audit, I don't think it is. So that became an item of debate. Now, I think in the new single audit, by the way, which we'll cover tomorrow, I think it actually does say it's part of the report package. So we don't know how to deal with that. But those are the two things to me that really fell into here. HUD has been silent, or the AICPA is silent as to what this paragraph was supposed to represent, because they wrote the report. And maybe they're opening the opportunity for us to just have other information. You just have to decide how you treat that. Here's the thing. I'm not too trusting right now of, say, PPC in some cases. They took an interpretation on some non-attest work, and had a checklist together which failed peer review. I know 3 people who have been, in the last 3 weeks, I talked to, who failed peer review by following their whatever checklist they had on non-audit services. So I'm a little circumspect on that a little bit. So I just want everyone to make their own judgment call about what that paragraph is or isn't to them. Even if you would conclude you have other information, you are not technically required to have the paragraph. That's a choice, but you ought to be able to make good decisions about why you excluded it from the sample report. Okay, if you're going to exclude it, then write down why it's excluded in your sample. And for me, I don't really care for the idea that, well, PPC didn't include it. They've been wrong before, and they're sometimes right, they're sometimes wrong. They're just like everybody else. I don't know how much actually Max gets involved in those decisions. So Max stays on the compliance side much more, right? In fact, he's pretty removed anyway now. So if somebody like Max were doing it, I'd have a little more faith in it, but I think it's really the PPC group doing it.
We also had discussion last year when this report came out about the other report required on gas and how it only, we went from mentioning 2 supplemental reports to 1.
Oh, if you came back, let's see, is this 14? Yes. Okay. The compliance report. So the reason behind that, and this one I don't necessarily disagree with. The other reporting required by government auditing standards was referenced as for the Yellow Book report. But the AICPA chose as a decision to not reference the other report because it's not related to the audit of the financial statements itself. So they excluded that other reference. However, from a standards perspective, this is other information, right? Other matters paragraphs. Technically, if you still thought you wanted to refer to the compliance report here, you can do that without really any harm under the standards. The only problem you're going to have is your peer reviewer is going to be following something, and he's going to say, why do you still put this in there? And my argument would be, because I like it. Bite me, right? Sorry, I'm on the room. Sorry, Frank, I said bite me. So that's the challenge. So a lot of people decide, it's just not worth the hassle. I'm not going to do it. But that was the excuse as to why. Did that really was that a great excuse to me? No, I think it's a stupid excuse, really. But it is kind of what they said, and I'm not going to swim upstream. Like my idea of swimming upstream, if you're going to swim upstream, you better have a chance to spawn at the end of the trip. If there's nothing to gain up the edge swimming upstream, I'm probably going to go, why go through the hassle, right? Sorry. I should cover my microphone. See, every time this thing... Okay, anything else? Yeah?
I hadn't seen, are we anticipating and seeing that in the nonprofit as well?
No.
That was just in the for-profit.
That was only in the for-profit. No, I wouldn't. Well, let me tell you why, too. You can have the other paragraph, but why it's not there as a standard thing is because, number one, in single audit, you're not required to put all that stuff in the prior audit finding report. And I think there's a valid argument about the corrective action plan not technically being required as a component of the report package. At least there's no history of ever having done it. So that is a change and justifies a difference between the two reports. In my opinion, it justifies that difference. You could have other information, but whether you have it or not, it would be different other information, like content of the board or whatever. So I see all kinds of stuff in there. If you do that, then that's clearly other information, and you want to make sure it's highlighted. Yeah. Not for the nonprofit, because they don't have the same requirements to include the same information in them. Okay, Yellow Book report. I have to correct the problem I told you. I have to confess I'm wrong. I told you last year if I have a significant deficiency, a certain significant deficiency, such as segregation of duties, that we do not intend to fix. I have a tendency to not report that with a finding and a finding code. I would report it in the body of the report, which is allowed. HUD wants them as findings with codes. So now you've heard my retraction. Now just don't ask me if I've changed my behavior personally. The answer would be no. I still don't want to open that door, but I have to tell you, HUD wants those things as quote-unquote findings in the schedule with a finding code. Okay? There's nothing wrong with the report. It's just I interpret something one way, they don't like it, and I have to tell you not to do that. Now, by the way, I want you to focus on this compliance thing here. I want you to remember this because we're going to come down to a discussion on findings in a minute after lunch, where we say, as part of obtaining reasonable assurance about example entities' financial statements are free from misstatement, we perform tests of its compliance with certain provision laws, regulations, contracts, and grant agreements, non-compliance with which could have a direct and material effect on the determination of financial statement amounts. However, providing an opinion on compliance with those provisions was not an objective of our audit. I don't really like that paragraph because we are segregating our audit out into audits of compliance, but they just are saying as part of our audit engagement for the financial statements, we are not doing that, which is true. But I want you to remember that phrase. Because in the finding discussion, we have to come back to that phrase. Okay, remember me. Compliance report, there are two issues here. They're not really issues per se. This one is just a reminder as we go through chapter 3 again that the compliance requirements that are applicable to us are those that are direct and material. And in fact, A133, the new A133 says the goal is to test things that are direct and material and not to focus on minutia. I want you to think about that as we go through this afternoon too, okay? Because a lot of misconception comes out about the audit guide. And then the only other comment coming out of any of this is just this table still. Include, not include. I don't know what you guys interpreted last year. I still prefer it. I haven't heard any great arguments against it other than it's technically not required. I said it's only technically not required because the Audit Guide Chapter 3 is 6.5 years old, and when it was written, there was no possibility of having it different. So I expect HUD to put it back in, but that's fine. So you have to decide that. Those are the only three issues coming out of the reports that have been pointed out over the last year. And of course, then the only other comment I could make at all in here is just the schedule of prior audit findings and items 2 and 3 in there about findings from other audits. There are several firms who have told me, frankly, they just won't do it. Big firms. So people tell me about not including that. I'm going, look, what's the risk? You're supposed to put it in here, but you didn't. So what's the risk? I don't know. I know this, that clarity required me to ask those questions. So this actual stuff, we were required to get under clarity standards regardless of what HUD said. The fact that HUD OIG added this requirement in here to document it is not that big a deal to me. It's a documentation of our own clarity standards. And again, only the findings. But I've seen a wide range. Don't do anything. Include everything. And, of course, my position, which was in the middle, I literally had somebody send a submission in with 17 prior audit finding issues under number 2. 17 separate prior audit findings for the physical inspection. Each one of the findings they listed separately. And I said, this is the... So we summarized those. But some firms are taking the position they won't disclose any of it. I don't know. I don't know what the risk is for that. I'm not sure the peer reviewers are asking that question. But peer review right now is more interested in non-audit services. So in the last few minutes here, I'm going to skip all the findings. So we'll go to slide 40. Slide 40 is really discussing just how to calculate, and I think it's pretty clear to everybody. The only thing that was of interest that they added here to make sure everybody understood was IRP on a Section 236. So if you had an interest reduction payment, that stayed in here. Otherwise, they were following the single audit rules. And now there's only one change between this and the new single audit, by the way, and that's here. Loans outstanding as of the end of the year. With the new single audit, it's loans outstanding at the beginning of the year. Okay, so that measurement process is going to take place there. Some template changes on the schedule of prior audit findings just to make it easier to put stuff in. No big deal. You still have validation errors because they can't still compare unmodified to unqualified, and it still fails. So they just haven't fixed it yet. And I don't think that's going to be fixed by year end. Now, the notice here on IRP, not really interested in a tremendous amount of information here. This is mostly process, a new process, how to get your decoupling done. HUD is very interested in the decoupling process because it moves them out of this 236 mortgage into a new 223F mortgage, which is where they want them all. The only goal for me is to talk about one thing in particular. Well, two things. Let me get down here. Basic rents. Oh, slide 56. They can restructure their distribution methodologies and in this decoupling. So it can change their regulatory agreement. And so that would have a problem there. In fact, most 236 that is decoupled did have that change that needs to be looked at in the decoupling. And, of course, the use agreement goes on for a period of 5 years beyond the 5-year the maturity date of the existing mortgage plus 5 years. So that was the other thing that came out of this for a compliance test. Okay, I think that's about it that were of interest to me, really. That lays our foundation. Now, we'll talk about audit findings right after lunch because that's the other judgment you need to make of how looking at compliance areas before we decide how to test. So we'll do that right after lunch. It looks like lunch is almost ready. Probably need to give you 3 minutes. Look, this herd of hungry animals is going to attack you. Let's be back at, 12:40 is okay? We're right at noon, right? Aren't we at noon right now? Section 5 of the book is the work of a couple of young ladies at another firm. So I would offer this out again as I always do. If anyone from this firm ever wants to develop their public speaking skills, we'll give you more than ample opportunity if you just want to come and do that. These two young ladies put together a discussion that you see on these slides in Section 5 on reporting non-compliance. This section applies equally to both HUD, single audit, or any process where we have a compliance reporting module with internal control. And the purpose of this discussion is to basically highlight the process for determining how to exercise judgment in the reporting process. Because you end up having a lot of judgment, and if I'm asking Jana if something's a finding or not, she'll probably go, yes, no, right? She'll do that fast. She makes that decision in her mind. But what's the problem with most of those things is nobody's actually writing down why they, in particular cases when it's not a finding, nobody's writing down why they determined it was not a finding. So we wanted to come to a process that left us with a discussion of common findings in HUD stuff, but more about how to actually make it happen. So this is the part of the day that I expect you guys to have findings to discuss. Okay? We can take through a few. And I've got a couple anyway that were interesting to me, just because of the situation that made them rather unique. But again, in most cases, there isn't a right or wrong answer. It's about process for how you came to your conclusions. This work, by the way, should happen at the staff level. This shouldn't be reporting at manager or partner or whatever. These decisions happen as soon as you encounter non-compliance in your testing. Now, we've actually developed a spreadsheet for it, a little template thing. You answer a series of questions, yes, no, and we force you to put some documentation in that summarizes the event and how it will affect reporting. We'll cover that in a minute. But what's most important for me, one, documentation of the process and how you reach that, and so how to report, internal control. I'm probably going to change the presentation a little bit just for continuity purposes, because I'm not really interested in talking about how to report the findings and REAC and all that. That's not my goal here today. But they put it together with that. So what are the frequent findings we see? I don't know. What are the findings, you guys? What are the findings you typically report if you have findings, or the non-compliance you see? Anyone can volunteer here. Single biggest thing, okay, of security deposit. So assets less than liability, right? On the security deposit. What else? Equity skimming again, right? Equity skimming, equity skimming. Okay, replacement reserve, or not making the full amount. Oh, okay, so mortgage payments late, as opposed to not making them at all. We've got some of these down here, and of course, the first question is, I see the second one. Not made within 90 days. Well, what if they're made in 94 days? Do I have a finding? Well, I certainly have non-compliance because the compliance requirement was to deposit within 90 days. So we see a lot of these also where the HUD had notified the servicer of a change in the report of the reserve requirements. They took 1 or 2 months to work it into the mortgage payment. Did the client do anything wrong? Really? So who's in fault? Well, the servicer's kind of at fault there because it takes 2 months to work through their system because all the record changes that happen in we do a lot of HUD-approved lending, and servicing is a huge problem in that area right now. So they're very cautious about making changes to servicing records at the lender. But it's still a problem because the client was notified of the change. So we have those issues. Now, one of the partners who I've talked to recently, his clientele, mostly 232s, he says when he sends his team out for interim, he says, I don't care what the hell they do out there as long as they do this. They look at those reserves and they look at those security deposits and they say, here's your number, don't screw this up. I'm giving you a month and a half to be correct. I've fixed you up now. If you screw up between now and year end, you will have a finding because you just deserve it. So that's one thing they do at interim is to make sure they have accounted for all those deposits, particularly on the reserves when the amounts might have changed. So anyway, there's in some cases we don't have a lot of things to deal with. There's not a lot of leeway, but the 90-day thing, there is some leeway, and we can talk about that here in a minute. Security deposits, single biggest thing you guys said was underfunded. That finding is pretty common across the board. Tenant files. No problems with tenant files. They're all clean and pristine. You're laughing. And how they crop up. So let me just say this about tenant files. Here's the one that came up in class. It was a firm training, so the client was actually there in the morning. So this conversation started before lunch, and then the conversation finished after lunch once the client had gone home. So here's the thing. Here's the scenario. I have 100 projects under audit. So I'm mostly with Section 8. So they decided the best way to handle this is to go to group project-based sampling. So they had a sample of 20, 1/5, right? So every project was covered every 5 years. They were way above the minimum of 4. Client agreed, and they said if we have a finding, we'll report it everywhere. Those are the rules, right? So they picked their sample of 20, and they came up and went through the first 18, slicker and a whistle. On the 19th project that was audited, they found a sample. They took or selected a sample of 14 items. Well, under that sample, 10 of the 14 that were selected did not do the recertification in a timely manner. Everything else was perfect, by the way. So when the recertification was performed, it was generally done within a 15-month window. And the reason for but there were no major changes based on the recertification effort. So why it had happened is the lady quit. The site manager quit. Okay, that's all there is to it. She quit, and for a period of time, they were not keeping up on the research. So, one project out of the 20 failed, one kind of an attribute. Finding or not. Now, I don't care about, I told them I want this conversation to be completely independent of the decision to report 100 times, right? The issue is this a finding? Okay? The firm had concluded, by the way, that it was a finding. Now, we'll talk about how to evaluate this in a minute. I just want to set that scenario up for you in that way. The second one that came out of class was a smaller entity, 50 or 60 units or something like that. The test was performed and found out everything was perfect. But somehow along the way, one of the auditors made an observation that the only consents in the file were the original consents. I didn't know whether that was an item to be reported or not to be reported. So they were noticing that was the only dilemma that they saw in the tenant files. And based on their analysis, they elected not to report that one. Different firm. So we had two different scenarios. Now, they kind of represent, these two scenarios represent issues in tenant files of various kinds of things. By the way, in both cases, rent was completely calculated correctly based on their determination. So no material adjustments to the actual Section 8 subsidy. So signed forms of this nature, what should we do? Well, we'll go to there in a minute on how to evaluate. But those were two scenarios that came up. I don't know, maybe you guys will share something later about a process or something you're going through right now. So, but we can apply the model to it, because now there actually is a model, but nobody knows what that model is. They have the model, I guess, or the concepts of the model embedded in their brain. I never had written this down. To me, I make my decisions like Jana does. I ask a few questions. What about this? What about that? Blah, blah, blah. Oh, it's not a finding. Don't report it as a finding. But the problem with that process is the same as when people call me and they say, Les, is this a finding? Well, I don't know. What are we talking about, right? So send me the facts or discuss. We'll start on the phone. We go through these, and I ask a series of questions. Have you considered this? What about this? What happened here, right? Whatever that conversation is. Do you know how it ends in their work papers? Les said, no, it's not a finding. Hallelujah. Yeah, hallelujah. I can't believe that's what you're quoting me on. What's that?
I said, that's what I put in my file.
And I know that's how it turns out, but they've ignored the complete purpose of the conversation. It wasn't Les's I didn't make the determination for them. I asked them a series of questions that allowed them to make their own decision about the finding, right? I'm not saying it's a finding yes or no. I can do that, but that's not really what we do. I'm not here to make those judgment calls for you. I lead them through a process of questions where they come to the conclusion themselves. But they never write it down. So tenant files are a key one for me, and they deserve quite a bit of attention just because there are so many ways to find issues in the tenant files. It's just the way it is. There's a lot of things going on there. Okay, related party loans. Surplus cash notes without authorization. Entering into a loan without approval. Now, they put that here about a loan. Quite frankly, you can enter into loans as long as they're for reasonable operating expenses. So things like a copier, a truck, maintenance vehicle, something like that. You can go borrow money on that. You can't borrow money for things that affect the building because those aren't reasonable operating expenses. Those require HUD approval because now you're dealing with the building or HUD's collateral. So anyway, paying related party receivables. Look, all the related party stuff is very significant. We spend a little less attention on it than RD does. RD spends a little too much attention in some ways. We've had this discussion with RD before. RD is completely, I guess, off their rocker on some of this stuff. And their OIG group, I have a little thing tomorrow to share a little bit with you on the RD side that highlights the real problems with RD, and the real problems aren't auditor related. The OIG blames you, by the way. All the problems that exist in RD are blamed on the auditors. Did you know that? Because you don't do the right work. And they come out to do their review, and they have tons of findings, but they look at your work papers and you have no findings. And they're curious as to why. Well, why is that? Well, because your audit focuses on the financial statements. How many findings do we have in HUD that we would report at the financial statement level? Virtually few. Very, very few. And when we ask for an opinion on compliance, we generate more findings. Well, that's just because RD never asked for the right work to be done to begin with. Anyway, so we have the related party issue here. I don't think we pay as much attention to it as maybe we should, but we have that problem. Now, I talked about apps earlier today. Flags on a property are handled through a system called Active Partner Participation System, APPS, APPS. This is the way they track compliance with HUD regulations. And if you have non-compliance, they put that flag out there, and it affects everybody associated with the project. And it ripples down wherever your Social Security number is. It affects you on whatever project that is. So the tentacles are very wide on the flags. So that's why putting non-compliance flags in is problematic for us, especially in certain cases where multifamily chooses not to enforce a regulatory requirement such as surplus cash because it's a bookkeeping entry, and maybe DEC does choose to do that. So anyway, we're worried greatly about flags. And this is a place you as auditors don't typically see very often. So when people have those problems, the very first thing I do is I say, send me the statements, because I could probably in 5 minutes find out where your flag came from in the statements. So they say, I have this non-compliant. Where do they detect this problem? I said, well, give me the statements, the way they look and react, and I could probably tell you in 5 or 10 minutes, this came from right here. You know how to kind of see those. Now, you're probably, as a firm, better at that because just the quantity builds experience over time. You can't have that much going on without learning from it. So as a firm, you're doing you're doing great. And I don't think your firm's ever really had a problem with QAS, have they? Have they ever been here?
Yeah.
Once.
Yeah, once about 12 years ago, so.
You can remember that?
It was yesterday.
She hasn't
We
gained.
don't want them to come back.
Yeah, well, she says she hasn't even aged a year in the time since the last time I came. You were an intern. I wouldn't remember that if I'd have been an intern.
Is QAS still going out to firms?
Yeah, they are, but not as much. They're spending a lot more time in public housing because public housing has so many problems. They're actually using their staff as on-site employees of housing authorities that are troubled. Now, did you ever know a guy named Elias Castellano who was with QAS? He's a Cuban, a kid from Cuba. I had a CPA firm, and then he went to work for QAS. And him and Wendell, they put a lot of stuff together at that time. Now, he swears it's him. I'm not sure how true he is because he's full of crap sometimes. One night we went to dinner. He was near his apartment in Alexandria. And he came out of the high-rise condo with his shirt unbuttoned to here and this 7-inch gold cross, his hairy chest shirt open, right? I was so intrigued by it, I stared. Oh, Elias, you're so hot with that cross. It's turning me on here. Dude, can you button up that shirt? And, well, anyway, here's the funny story. So he goes back to work for his own firm. And in the meantime, David Vargas, who's the head of REAC, asks him to go to the Housing Authority of New Orleans after the big disasters there to help clean up the mess. He needed somebody he could trust. Within a year, he's been indicted on federal charges of all kinds of corruption, and he went to jail. So that's my idea of quas right there, right? He went to jail. And anyway, so they're spending a lot of time taking their employees and sitting them at housing authorities, maybe like Mormon missionaries, always in twos, so they don't have these problems, and it's the only way they will ferret out all the dishonest stuff going. So they're really busy, and so when they pick up these jobs, they start probably with housing authority, and then they backfill into firms that do housing authorities where they also do multifamily, and then they get some coverage in multifamily. Very few. There were 3 firms last year specifically targeted by them for transactional issues because the field office had approved a certain thing and Quas didn't like it, I guess, and they went and visited all 3 firms. All 3 firms survived, but that was a rather unique experience because all 3 of them were multifamily only in New York, same transaction, and they went and looked at all 3 of them. And they may have been actually auditing more the field office procedures through the financial statements of the owners. So they're not that big into this right now. They're nowhere near any risk to you, really. Has an audit risk. If you sit down as a firm and say, what is our risk on these audits? Quas is somewhere below. Certainly economics are a big thing. Peer review's up there, but Quas is somewhere significantly below that. Okay, entity expenses, new loans. They're talking about entering into loans. I talk about new loans from a different perspective because every time we get a new loan or have a transaction of that nature, there's about a 50% error rate in reporting items like that. Specifically proceeds from loans that owners keep. People misrepresent that all the time. And HUD is quick to nail them for it, and it's not really true equity skimming. So we have those going on. Now, I talked about underfunding security deposits, first of all, before we get to that, the model here. Our most partner people we talk to do not want to report findings for security deposit cash being lower than liability if the situation is really temporary. They missed it by 3 days, right? Because somebody was on vacation at year end, had a great New Year's Eve party, got drunk in New Orleans, didn't come back for 2 days, but they came back with a whole shirtload of beads, right? She had a good time. But in those cases, they're not that anxious to report findings. They don't want to see that finding there because they're opening a door to a bunch of other things. So the first line of defense for us now is review the liability. Because the liability may include pet deposits or other things that aren't required to be segregated. Now, after that, a lot of people just simply make cash entries. Because the cash entry probably happened on the 5th or something like that, they're going, you just made it early. And I think you're well within your judgment to do that. Is that material to anybody? $400, if we get to that level, we're going crazy. So a lot of people will just do that because based on their judgment, the reporting of the violation brings so much more items of risk to them than the actual violation. They're willing to ignore the violation, right? And I think they have the right to do that. I'm not suggesting otherwise. HUD would be very angry to hear that. But on the other hand, HUD needs to be protected from a lot of over-reporting in and of itself. And HUD, we need to make those decisions. So we're good with doing that. The deposits on the supplementary income statement, look, that's a problem, and we're going to have to deal with that. So we spend a lot of time training about how to identify the flags, how to deal with that, what's going to trigger it, and we're good with all of that. So let's just move into the model itself. Now, what is absolutely required to be a finding? Does anyone know what HUD requires to be a finding? It's a lot of collective silence. It's not a trick question. What's that? Material noncompliance, right? We all know that one. I'm required to report material noncompliance as a finding. Anything else I'm absolutely required to report. Oh my. Fraud, equity skimming, right? Those two things to us are really the same in HUD's mind, right? Equity skimming equals fraud, and that is a zero tolerance policy. So all items of fraud or equity skimming. We agree. If I'm reporting material noncompliance, you can also bet that I'm reporting material weaknesses in internal control. Likely, right? Now, HUD has certainly requires some additional things because they require this reporting of immaterial or non-material noncompliance. I don't like to say immaterial, non-material, because I may have something completely immaterial that I'm not going to even highlight at all. Okay, it's $20. So I call it non-material noncompliance. Well, the HUD Audit Guide sets the groundwork for this, and it's a little confusing. So start at Chapter 1, and it says, starting at this fourth line, HUD requires that all instances of noncompliance with any HUD requirement or regulation, material weakness and internal control, all instances of fraud or illegal acts and contract violations be reported as findings. Well, that's nice. It's also wrong. We are not required to report all instances of noncompliance as findings. So we know that's not true. So I go to chapters 2 and 3, and they tell me material noncompliance, and then they say deficiencies in internal control, equity skimming, instances of fraud or contract violations are to be reported as findings. And I say, okay, that's great, except that's not true. We're not required to report all deficiencies in internal control. So really what the end result is, for most of us, we're reporting all instances of fraud, material noncompliance, material weaknesses in internal control, and generally most significant deficiencies. So that's where we sit. Now, HUD said further, and this is a little more of a problem for a lot of owners, if noncompliance is detected in the year but was corrected before the issuance of the audit report, it is still a finding. So there you go. If you detect noncompliance that happened and it was corrected, it's still a finding. Now, material noncompliance. So I'm going to skip on the equity skimming thing. I think we've had enough conversation over the years to not have to focus too much on what equity skimming is. So now we come to the model. All that stuff kind of is behind us now, the general stuff. Let's talk about the model. Okay, so every time we see a diamond, we have a decision point that requires some sort of documentation. So in this case, describe the issue. Is it likely fraud? Yes or no? If it's a yes, we're into the schedule of findings and question cost. That's not really an acronym. That's just our abbreviation because I didn't want to type bigger. And if the answer is no, I may have to consider increased disclosure to REAC. Now this gets to be dangerous. Let me give you the one scenario that happened this year that caused somebody a lot of grief. He goes out to the site. He shows up. He goes out, and there's a new person sitting in the chair. He goes, hey, where's Mary? Well, Mary doesn't work here anymore. Okay. Calls the owner. Hey, where's Mary? Well, we fired Mary. Well, why? Well, we think Mary stole from us. Oh, really? How much? Well, he says, we think it's about close to $2,000. We're not exactly sure yet, but it's $2,000. Oh, really? When did this happen? Oh, 2 months ago. So what does the guy hear in his mind right off? He heard the F-bomb, right? Fraud. Which constituted another F-bomb, which was finding. And that caused the third F-bomb, which was you're fired. Literally. Which caused the fourth, which you can imagine how that went, right? We're finally down to something else. So here's the dilemma. He calls me and he says, Les, he told me the facts. And he says, what are my choices? And I said, this is simple. You only have two. And he goes, what are they? I said, you either report or you don't report. Well, what do you mean I don't report? You just choose not to report, right? That's your choice. Right? The three monkeys are up there on the shelf. And he goes, well, oh my gosh. I said, so are you willing to not report? Well, he hums and haws. He kind of stutters just a little bit. He's nervous. And he doesn't have a lot of confidence. And he says, this year's peer review, and there's not a chance I'm taking online about this right now. Oh. I asked him, I started laughing. I said, does it mean if this were not peer review, you would have a different answer, right? That's not what I meant. Les, dude, I understand, okay? You were going to lie. Just now you're afraid to lie. Because he knows he's in trouble right now, too, right? Is he doing the right thing? That's what he called it. He wants to know, Les, am I doing the right thing? How the hell do I know? It's your client, right? Did they steal? Yes. Is that fraud? Yes. Does that mean you should report? Well, yeah. Okay, do you want me to tell you to be a good boy and report? So he says, well, I don't really want to lose. There were 6 jobs, bless you. 6 jobs this client had. He's now fired. And this guy is a sole practitioner, and these 6 jobs are good. It's decent revenue for him. And he's going, oh, can you help me? Oh, Mr. Wizard, can you help me? I said, send me the finding. Anyway, who's at fault in this finding, by the way? Is the client at fault? Hell, the client did everything right. In fact, the client's a hero because they caught this woman in less than 2 months. So the client feels unjustly poked in the eye with a sharp stick because you're going, you have a finding. And he goes, that finding is negative to me, right? That's a negative comment about me. So I said, look, let's rewrite the finding to be a little more descriptive of the situation, which really was what? Whatever her name is, chose to steal money. She's the one at fault. We've caught her and fixed her, literally. She's fired. And we've even started to process our fidelity bond claim. Project has been made whole, and in fact, the internal control system worked spectacularly. When the finding actually was restructured to say those things, the owner goes, well, that is kind of what happened, isn't it? Yep, that's what happened. And it didn't look negative to the owner. It's a finding, but it's not. It's a finding about, what's her name, being a dishonest little creature from hell. Okay? So in that case, he saved his bacon by actually rewriting the finding. And I said, look, the idea behind auditors is that findings are negative. Because we're negative. My daughter says it all the time. You're a glasses half empty kind of guy. So that's why she's in psychology, Jana. Right? She's going to fix Dad sooner or later. Yeah, it's just a huge. I said, your mother's put a lot of effort into this girl. She's pretty dang smart, so I don't know how far you're going to get. My wife is a little more wired into this situation. Anyway, enough of me. Enough of that. That's embarrassing. We get a tendency to think about him that way, and the answer is it's not that way. In every case. Sometimes you do screw up, and it's wrong, right? Sometimes other people screw up, and we have to report that. And it's not necessarily it's a finding, but it's not. The way we write it has direct impact onto the perception of the finding. In this case, the finding is essentially that what? She stole money, and the internal control was found to be totally effective. Now, the only thing that's negative out of that is, she did steal money, but the project isn't going to be damaged. Why would somebody have likely not reported that? Because they're going to say what? The project was never damaged. And because I don't want to report a finding because of the fraud, because the client didn't do anything wrong. I can see that. But the model is to report all issues of fraud, because HUD OIG in many cases wants to go back and decide themselves which cases to pursue. And that's really what that's about. So when OIG gets involved in multifamily, it's not that often, but it's always a specific answer to fraud that has occurred at the site. And almost always reported by the CPA. And then they go back to actually pursue a fairly large case against the individuals involved. Okay? So that's our fraud model, and it's not that hard to apply. It's pretty straightforward. The only question is, when we decide to call something not fraud, we're going to be required to document why we elected to not comply with the mandatory requirement of reporting a finding. And I don't care which way people go on that, as long as they document their answers or their choices as they flow through the process. Now, let's go to the next one. Oh, the next one's abuse. I've only seen this once. I've never actually seen it reported in an audit report. If you go to an AI CPA training on Yellow Book, they'll talk about this for a half hour. You need to report abuse. You're on the hook for abuse. You're on this for abuse. The only abuse I'm sitting here dealing with is the abuse of listening to this conversation for 5 more minutes. Because not one person I've ever seen has ever reported this that I know of. It's a great theory. But even on my 18 Chevy Cavaliers, if I were the auditor, what's the client going to tell me the minute I report that as an abuse finding? Well, HUD approved it. Well, it can't be abuse if HUD approved it then, right? That's the theory. So everybody gets backed into the corner. Nobody reports this. We don't have to talk about it again. Now, communication to HUD, let's skip that. Here we are at the model. This is where we will spend all of our time, or 95% of our time in this discussion. So we're testing compliance. We detect non-compliance. We must decide how to report non-compliance. So all items of non-compliance that we encounter in the work papers must be resolved. They either resolve as findings, or they resolve as non-material non-compliance reported to the client in writing. We have to choose there are only 2 choices. Branch A or branch B, right? So we're left with trying to decide which branch to follow. So here's how the model plays out in the real world. And we just tried to write it down in as good a fashion as possible. Is this item of non-compliance resulting in a question cost greater than $10,000? Why $10,000? Well, because that's the single audit limit, first of all, right? If you have an item of question cost $10,000 or above, it's a finding. We also know our deck limit's $10,000. So for us, this is technically, I guess, a little bit of an arbitrary statement of significance. Some people, had I not had this $10,000 limit imposed by, say, DEC or single audit, maybe this amount is exactly what we compute as tolerable misstatement of compliance, tolerable noncompliance, as opposed to material noncompliance, which we'll talk about later. So this is a measure of significance that forces us from a dollar value to report automatically as a finding. Single audit right now is 10. Next year becomes 25. That's a huge increase over that time. DEC will probably stay at 10. In my case with the tenant file tests, they didn't actually have a computed question cost. So the answer to that was no. In fact, on neither of those did I have a question cost, really. Subsidy was calculated to be correct either way. They just had some items of non-compliance. So now we get down to the next discussion. We answered no. It's not over $10,000. And in fact, there's no actual dollar value limit. It's when I fold my arms, I guess, or I touch this cord. So I ask if it's, now by the way, in the book says material in that top thing here. The word really should be significant because I didn't want to confuse materialness with qualification of report. So this is just really significant. Is this a significant variance, either quantitatively or qualitatively, to a compliance requirement or an audit objective? So, what's the audit objective on Section 8? It's only one. Get out of training early. It's compliant. It did. That's all we're asking. That's the only audit objective in the tenant file test. Was subsidy calculated to all within all materiality or with all material in all material respects? I can't say that. In our case, a missing a delay in the processing of the consent of the recertification didn't result in a failure of the audit objective at all, did it? Subsidy was calculated correctly under either scenario. It's just one got recalculated late. Okay, well that was easy. How about the audit requirement? Okay, so we have the audit requirement. Oh, that's the old one. Sorry, I got to get the right one up. Okay, so here's the audit guide. Now, when it says a compliance requirement, just like A133, we're actually asking about each section, right? The compliance requirements are listed in the audit guide. So here's our compliance requirement of tenant file testing. And it goes up here a little ways. Sorry, my mouse doesn't scroll any faster anymore. So tenant application eligibility and recertification. Okay, so what are our suggested procedures? Get a copy of the HAP contract. Get an understanding of procedures. Review field reviews. Applicants selected from the wait list. Okay, that's none of that. Sample of tenant files. Perform a minimum of the following. Everybody signed the app. Correctly identified members. The consents were in place. Verified our Social Security numbers. Resident rights and responsibilities were acknowledged. Citizenship was declared. Tenants were screened. Model lease. Security deposit. 5.9 was completed correctly. Move in and move out. Computation of rent. Whether the initial and the last recertification forms were completed correctly and were accurate. I guess where I got to was this one, right? Because in technical terms, it wasn't completed correctly because it was completed late. But that's the listing of the compliance requirements as we see them from HUD's perspective. Now, maybe that's not exactly the compliance requirements the client has, per se, but we'll talk about that difference in a minute. But that's how the firm evaluated this. Well, actually, how they reevaluated it in class. Now, if that's your finding, do you conclude that this item of noncompliance they encountered was, in actuality, material noncompliance? Or was a finding? Was significant enough to be a finding? What would you say? I prefer not to say it, Les. They concluded at the end of this conversation, with some discussion, that likely it probably should not have been a finding. Let's put it this way. There was ample reason for them to have not called it a finding. The fact that they called it a finding could also be discussed as a potential item too, But they concluded that in their mind, as they revisited this, they had not substantially or qualitatively violated a compliance requirement to the level that it required a finding when they had originally prepared one.
Wouldn't you have a question of cost because they were receiving incorrect subsidy amounts?
But there were no substantial differences in subsidy. It was very small, if any. So they're saying, look, everybody was getting the right amount of money. What's that? Retroactive. That's true, but here's what happened. When they did recalculate it, they didn't have any substantial differences that were retroactively applied. I asked them that specifically. Was rent different? And they said, no, not really. Rent, for all material respects, didn't change hardly at all. Once they were done, rent didn't have any material changes at all.
How many of these were prepared late?
10. The sample was 14. 10 out of the 14 were late. You're a finding. Now, would that change your mind if you said I had the finding and I'm going to report it 100 times? Because I'm on group project-based sampling. In their case, they really had to. The cost was just too much because they had a lot of tenant file testing in 100 projects. So they had concluded, both them and the management company, the owners, it just wasn't going to work to do it the other way. Of course, they were very, very unhappy when the CPA did report it 100 times. Especially at the end of the meeting, at this conversation where they concluded that maybe it might not have had to have been a finding. Now, obviously, we're not all that concerned, per se. But they verified income another way? Well, I'm not sure the process broke down because they just elected not to use it, right? Well, that's what I'm saying. They just elected not to run it. So the question is, they had non-compliance because they elected not to run EIV. So if I came back to this, sorry, this didn't exactly create the thing I wanted to create. If I came back to this discussion and I went back to the HUD audit guide, so I go back, okay, is it qualitatively or quantitatively material to run EIV or to not run EIV? Okay, so we go back. Now, this is the problem. You're going to see another problem here in a minute with this that I haven't pointed out exactly yet. So everybody signed the app. Household members were identified, blah, blah, blah. Resident rights, citizenship declared, screened, model lease, security deposit, owner certification. The 5-9 was signed, completed correctly. Computation of contribution for rents and utilities. So when I look at this, where did it ask me to actually get the income from? Well, it was in the notice, but see, here's the thing, right? That notice, how appropriate were the requirements in there? So let's assume they actually did third-party verifications of everything. No EIV, just elected not to run it. So go through that list and tell me how you feel about that. Is that a material violation in compliance? Or significant even? Forget material. We're only asking, is it significant enough to be a finding? Well, see, this is a dilemma everybody faces, right? You're sitting here going, and maybe this is a situation you had. I don't know. So the question is, how do we come to that conclusion, right? And so the requirement says, did I violate something like a compliance requirement? Well, my compliance requirements are listed here. because they're not really summarized anywhere else. The problem with this is, what you're going to find out is this is wrong. The audit guide is wrong right now. So you tell me, what's the requirement on EIV to run it? At each annual and at initial intake and recertification. In fact, that's the primary vehicle you are supposed to get for your third-party verification at recert, right? Maybe not at intake, but at recert it clearly is. So in my opinion, we would look through there, and that may be how most guys do this because they cling to the guide. And I would argue, what did you argue, by the way? I'll tell you my answer is, what's yours? Okay, I'm with you. To me, it's a finding. It's a significant thing.
Regardless of whether or not you got the same place with the rent.
Yeah, regardless of whether I got to the same place with the rent or not. So, because, here's my answer. If you ask me, Les, what's the minimum I have to do at recertification? Happens all the time, right? You can't be naive. It happens all the time. So I said, look, signed consent. 5-9 completed correctly. EIV report, or I should say, household members identified. EIV reports ran, and if they're not in agreement, then they're resolved. That's probably my bare minimum of what has to happen at recert. In fact, you'll see that here in a minute where they agree with me on that. And this doesn't really make that clear. What was the... Go ahead. Well, the question is why didn't they run it on the one tenant? Who knows? Okay, so here's the point. You have non-compliance, right? At that point, you have to determine, is the non-compliance you've encountered significant enough? Sorry. Come on, go back over, mouse. I cannot drive from that distance. Is that item of noncompliance significant enough based on the... We already know it doesn't violate your audit objective because subsidy is still correctly calculated. So qualitatively, did they reach a level of significance that you want to report? So you say no. Why? So I've got all this other history, right? And you're going to write that up. So you're going to have to say, no, here's what happened. Look, I've tested X number of tenant files. They all have it. This one fails. So this failure in and of itself, which they did other recert procedures, to me does not rise to the level because they did all these other things correct. And in the scope of what my test is, I'm going to describe this and say no. And it's probably an item that goes to management in writing. His other one, they didn't run it at all. Now, on the next one, they didn't get their consents. They had consents on file for everybody, but hadn't gotten consents at recertification. So they came to the conclusion that the answer was no here. They went over here and they looked through all that list in the HUD audit guide, and they came to the conclusion again that the answer was no. Because they looked through here and they said, okay, everybody signed the app, everybody's here, whether household members are correctly identified and the consent to release, they had a consent, and they went through the list and they said, well, that's not material, that's not significant enough. But here's the problem with it. They basically misunderstood the requirement. Because what? A consent's only good for 15 months. Once they came to the EIV rules and the income report, they set the consents up to be effective for 15 months. So that you had time, you came in, we sign you up, we get your consent. We have now 15 months in which to conduct a recertification giving us access to all the reports before you ever come back in, sign a new consent, and the research procedures are finished, of which you sign a new consent to list you out for 15 months. So what had really happened is when the auditors, when I asked them the questions and explained the situation, they figured out that she probably had 34 either misdemeanor violations or felony violations of the EIV access rules because she had accessed the income reports 34 times without having valid consents. That's about 17 years in prison, and what's 14 times whatever, $5,000. Oops, that's a lot of money. So, you can see how they were approached. And they just made a big mistake because they went back to the audit guide and said, hey, the audit guide's my place, right? There's my compliance requirement. I said, that's the problem with what you understand is that's not really the requirement, is it? It's 6.5-year-old requirement. So on the one, they clearly called it a finding, where they elected, they probably decided they shouldn't have called it a finding. It felt really bad because by now the client had left after lunch. So by the time they came to the conclusion that they had reported this finding, or that they had options they hadn't considered, the client was gone and didn't have to hear that answer, which they were relieved. I was relieved. I didn't want to have that conversation. But on the other one, they said, oh my hell, we've really missed the boat here. That was a huge blow. And the same thing kind of flows with you. They hadn't done those EIV reports. To me, that's a major, major blow of noncompliance. So any model you look at, security deposits, is that a material significant quantitatively or qualitatively for a $600 difference? Now the audit guide will say we mandate you to look at the deposit being more than the liability. So that's a compliance requirement. But is it a material or significant violation of that compliance requirement by $400? And the answer for me would be probably not, right? But I know it'll look bad, so I make adjustments for it, all within the boundaries of my judgment. Because again, I ask everybody, are you really sure those amounts are good within $400? 100%. We're not that sure of anything in this audit. In fact, you know what I've told you before about being 100% sure of. You only have to be 100% sure of one thing. You guys remember what it was? Getting paid. There's no other 100% sure in this business. So, in fact, I don't even know getting paid is 100% sure anymore, is it, Jana? But that's the only thing we should be 100% sure of. The rest of this, we're making assessments and judgments, and the model lays it out so that our documentation of our judgment flows in line with that. And of course, if somebody comes in and says we disagree, okay, that's fine, we disagree. But we're disagreeing based on my judgment, right? And now you're just telling me you don't like me. Justin, you don't like me because you disagree with me. And you're going to say, well, no, it's not that. Well, you said you don't like my judgment. That's personal, so you don't really like me, right? And that conversation doesn't go very far. What goes a lot further is, hey, you didn't write down why you made this decision. That's a blow. So it's not a judgment issue, it's just you left it open for us to decide what happened. Now, the next phase of this conversation, no matter how you cover it, let's take my first one. The one they had called, they determined probably shouldn't have been noncompliance. So I really didn't even have to come over here, did I? So the second one with the consent, is this material to the major program? Your particular issue. They didn't run EIV. So now you've decided it's a finding, right? So we have that finding sitting there. Now we have to decide, where does this finding go? Do you think that issue is material to the major program? You do. Okay. I'm probably in agreement with Justin on this particular case. To me, the issue of the EIV reports is so fundamental to what HUD's attempting to do. The failure to run them opens them up to many more mistakes, regardless of what their third-party documentation showed. And so my opinion on compliance is going to be qualified. So now we're determining it's material to the compliance requirement, not just significant.